Anything but boring. That's the summary so far for financial markets in 2025. More on this now from Felix Brill, the Chief Investment Officer of VP Bank. Felix, bond yields in the US and also elsewhere have risen quite dramatically. What do they signal?
Well, it's always a bit tricky with interest rates because there's so many factors at play, but at least this time around we see a clear trigger for that move, and that was the Fed in December. The Fed signaled less rate cuts for 2025 because they see higher inflation risks. And as markets started to reprice, so pricing out deeper rate cuts, government bond yields started to rise.
How high can they go?
The sky is the limit, as you usually say, but I think the most important message here is don't bet on just one outcome. Be always prepared. Make sure that the portfolio is not on the wrong side if things turn out differently than you expected.
Higher bond yields usually mean bad news for risky assets. When will equity markets react to that?
Well, I would argue they have already reacted. If you look at the last couple of trading days, some of those days, stock markets were deep in the red. That was a bit of a game changer compared to, let's say, November. And that clearly shows there's more competition. If you have higher interest rates, it's more competitive for equity markets. They have to prove themselves that they are the right choice. But we think they will be able to demonstrate that, so we still like especially US equities.
VP Bank has added 2 asset classes to the portfolio. Swiss real estate is the first one. What's the investment case for real estate?
It is mainly due to the fact that we see already very low interest rates again in Switzerland. It's quite different to the US. So we are talking about 0.3, 0.4% for 10-year government bonds. So that is a challenge because now in the search for yield, you have to look for alternatives. And we think Swiss real estate funds, they stand out because they offer already a distribution yield of around 2.8, 2.9, 3%. And that is not even including the potential appreciation if property prices continue to rise.
And what's the case for industrial metals, the second new asset class?
I think that investment case is really interesting. We see massive investment demand for topics like energy efficiency or mobility. And at the same time, we see that supply is tight because we've seen not a lot of investments in production or distribution capacities over the last couple of years. So if a limited supply meets an increasing demand, that's typically good for the price of that product, right? And on top of that, we see a good chance that industrial metals alongside gold will make a portfolio a bit more resilient in case inflation will be a bit more of an issue for financial markets again.
Thank you, Felix. And that concludes our view of the questions. I hope you join us again next time. Goodbye.